That all being said, I had mentioned that we talked about the signature tools and we walked through, or we described, I should say, the long option finder. Now, the long option finder, what this tool allows us to do is you can put in any symbol, your expected stock price of the underlying symbol, your invested amount, how much you'd want to invest into options on that particular security, and the target date. Do you think the stock might hit that target price? So I'm just going to use an example, MMYT, make my trip. This is a position I was in as a married put. We closed it out recently. We allowed it to be assigned at 100. It went up to about 106, 107. Closed out of the position. It was a bulletproof standard collar. It was guaranteed to make 23%. I think it made about 35% on the married put structure. But, the stock went up to 106. I let it get called away at 100 because it more than exceeded my goals. But then it recently pulled back to about $91, $92, bounced back up today to about 95. So it's trading around 95, but I think, let's say it's going to go back up to about 107 or 108. And I'm willing to put about $1,000 into an options trade. Naturally, if I think the stock's going to move from 95 to 108, we're talking about buying calls here. All right, so I'm going to put in $1,000, and I expect that MMYT might hit this 108 range again in about 20 to 30 days. So let's go ahead and go standard October expiration, October 18th, and click submit. In that instant, what the long option finder did is it went out and looked at every available option on the chain for my underlying security. Based on my investment amount, it calculated how many contracts I could buy for each one, what the current position cost would be, what the expected value of that option would be on October 18th, my selected date, and which one is going to give me the best bang for the buck, the highest percentage profit if I went ahead and entered any of these positions. And the first one we see is the December 84 call. The ask price is $260. I could afford 3 contracts with my $1,000 investment, so it would cost me $780. On October 18th, about, 18, 20 days away, if the stock is trading at 108, as I mentioned, this 120 call would theoretically be worth $4.93. Well, yeah, it's still $12 out of the money. But at the same time, it still has 64 days to go to expiration. So there's still a lot of time value on this position. So my return would be 90% on the trade, and we'd profit about $1,479. Now, also shorter term, we could use a November 105 call. This is almost similar. It's about an 89% profit with a 1,600. We'd only buy 2 contracts. It's not as deep out of the money. So it would cost $880 for 440 for those 2 contracts would be $880, but we'd make a profit of about $831 on the position, about $4 on the position. So we'd take in that profit there. We'd have an 89% profit on the trade. Okay, now, there's no current volume on these positions. There was current volume today on the 15th of November 105 call. We see some other activity on the 15th of November 100, 110 calls. I think people are speculating, as we're seeing here. Or maybe they're doing bear call spreads. Maybe they're doing bull call debit spreads. It's hard to tell. But we've got 10 contracts at the 15th of November 100, 15 contracts, current option volume on the 110. So these might be bear calls, these might be bull calls, or they might just be straight option buys, expecting MMYT to go back to that 102, 105, 106 range that we saw recently. Why I want to bring this up is I had a coaching session on Monday with a gentleman who has a fair amount. He didn't give me numbers. He doesn't know the exact numbers, but he has a fair amount of physical gold and physical silver, safe deposit box, wherever he has it stored in his house, in a safe, wherever. But he wanted to know, what is the best approach? He follows someone on the internet who says that with the election coming up by December, there's a strong potential that based on the outcome of the election, we could see, or leading up to it, we could see gold and silver drop 15 to 20%. Now, I don't necessarily agree with that, but At the same time, the question comes into me, I have a fair amount of physical gold and silver. I don't want to use the futures as a hedge because we all know what the margin requirement, the monetary requirement, and the potential buying requirement is. Shorting, buying, doing ratio spreads on the futures. Hey, it's a great way to also divest and invest in different markets. But again, it requires a lot of capital. So we have the gold and silver ETFs, don't we? We have GLD, we have SLV, we have things of that nature that are going to mirror it. Even some of the bigger mining securities, Angkor Mines, for example, Barrick Gold is a good one, Wheaton Precious Metals for silver. Those are going to follow that as well. Those are options that you can use. Those are put options that you can use to hedge either physical property or to bet on a decline. Let's take a look real quick. What I want to do is let's just take a look at the current price of GLD. Just give me 1 second here. Let's open another window. Sorry about that, folks. There we go. So let's take a look at GLD. Where are we currently with GLD? Let's just look at quotes here. All right. So the ETF gold, we're at 245.02. Had a little bit of a drop today. So we're at 245.02. Worst case scenario in this expectation. The stock drops 20%, which is going to be about 48 points. It's going to put us just below just below 200. It's going to put us about 197 or 198. That would be a 20% decline. Again, this is not something I expect. But how can I use this optimized long option finder to help me find hedges? Well, let's just do it. We'll do GLD. Let's put an expected value of 198. We'll go further out in time, post-election. We'll go out to December 13th, 12/13/2024. Another Friday the 13th. We just had one recently. We got another. And let me just start off with $1,000 for now. Same thing. We'll go ahead and click submit. Sorry about that, folks. So we said 198. I'm sorry. That just jumped on me. We'll go 198 again. I'm sorry. $1,000, and our target price for this was December 13th. My apologies. All right, now, once again, we run through the tool. We see here that the best bang for the buck, they're all really close, but the best bang for the buck is the 20th of December, 214 put. Why the 20th of December? Why not the 13th? Well, if I selected the 12th, it would have showed me expirations on the 13th. Since I selected the 13th, it pushed it out to the next week. But anyway, these 214 puts right now, remember the stocks, at the underlying ETFs at 245. So with a 20% decline, about $48, pushing us down to that 198 that I mentioned, 197 or so. The 214 put, currently at a price of 48 cents. We could buy 20 contracts with $1,000 I put in. The position cost would be $960. And if on December 13th, GLD, gold, did drop about 20%, was trading around 198, my position would be worth $1,583, or a closing value of $31,660. I'd roughly have a profit on $960 invested of about $3,060, right? Just a little bit more than that. Does that make sense? Well, the stock's at 198 if it did fall 20%. We have a 214 strike put with 1 week to expiration, which is roughly $16 in the money. So this 1583 is actually lower than I would have expected. It should be around 16 or so because I've got stock at 198. I bought a 214 put. That's $16. I would expect this to be at 1610, 1605. Where am I going with this? Okay, so let's say that you had $1 million worth of physical gold. You're looking to hedge that because you're fearing a 20% decrease. So naturally, you'd lose $200,000. Well, putting $1,000 only into a potential hedge would hedge you about close to 32,000 against 200,000. What if I wanted to hedge half of that decline? So I want to be 100,000. Well, naturally, I just have to increase my investment amount, right? Let's say we go up to 3,500. I've got $1 million in physical gold. I'm going to spend 3,500 to insure it. Is that going to help me hedge half of the position? Let's run that again. And here we are. Yeah. The value of the position would be worth, it would cost us 456, and we'd buy 72 contracts. It's December 214 put in this case. So the 48 cents premium, we make $15.83. We make $15 and roughly 40 cents times 72 contracts. The value of our position is 113,000. Let's just call it 114,000 to make the math simple. We lost 20% on our $1 million physical holding of gold. Investing $3,500 would help you hedge more than 50% of that in a 20% decline. You'd have a profit of 114,000 on your put positions and a 3,198% return. We're not talking about that. That's not what we're looking at, but that's a hedge. Okay, so would I want to hedge a little bit more than 50%? Just put 5,000 in. Where's that going to put us? Sorry about that. And we'd be at 164. It costs us $5,000 now, roughly 104 contracts of December 214 put. But if gold fell 20% by December 13th, 2024, we had $1 million invested in physical gold. We'd lose 200,000 with that 20% decline. Our value would now be 800,000 with a $5,000 investment. We've hedged it by almost, what would that be? I'm sorry, it'd be about 18%, right? 19%. So our loss is hedged to only it's less than that. I apologize, ladies and gentlemen. The stock fell 20%. We would have had a $200,000 loss. We killed most of that, so we only have a $36,000 loss, which would be a 3.6% decline. My apologies for the error in math. Sometimes these Friday nights, the maths get a little hard on me. But that would be the hedge that you could use. So I just wanted to point this out. And we get some of these similar questions along those lines. Hey, I don't have any options trades right now. I have a security that's non-optionable. I have physical holdings in this. I even trade futures. How can I hedge against wheat futures or gold futures or things of that nature? You can use the long option finder that if you fear a price of falling in gold or silver, you can oil, OIH, for example, or if you feel there's a gain, you can use this as a tool to help you find positions for profit, help you find positions for hedge, and much, much more. So that's the long option finder in action. It's a very powerful tool to use for both speculation and for hedging of materials or physical holdings that you might not be able to protect directly, or if you don't want to use the futures to do that because of the margin requirements as well.